Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is managing an options portfolio. And when a trader's gone to the trouble to compile a portfolio full of all sorts of options strategies, the ultimate success or failure of those trades are actually going to be determined by a combination of three potential big variables: price, time, and volatility. So we're going to be talking about how an options trader might seek balance in their exposure to price, time, and volatility using the tools available on Thinkorswim. And specifically, we're going to be acquainting ourselves with a function known as beta weighting. I think this is going to be a great discussion. We're going to introduce the Greeks. We're going to have a lot of fun with it, even placing a new trade. So before we get to any of that, though, let me first of all say hello to everybody who's out there in YouTube. See a lot of familiar names out there. A very good personal friend of mine has jumped in as well, but great to see everybody. Will and Austin, Mighty Mouse, Josh, Mary, I'd Never Eat Hair, Christopher, Life in the Fast Lane, Nick, Sharon, Wayne, everybody else. Thanks for joining us week after week. I always do appreciate your attendance and your contributions to these discussions. Now, I'm here just on a fill-in basis. I actually used to teach this webcast series. I don't teach it any longer, so I'm just here for the one time, but I do still appreciate everyone's attendance today. It's always appreciated. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, well, enjoy the presentation, but be aware that you're invited to join us in the live discussion. This is a Wednesday webcast series. It kicks off promptly noon Eastern time each Wednesday. We'd love to have you here in the live stream audience. And as a great treat for the live stream audience, my very good friend Ben Watson is joining us here in the chats. It's a second friend in the chats. Great to see Ben here with us. Ben's just going to be helping out with any questions that I can't get to during the flow of the presentation. Ben is fabulous, brings a ton of experience to this discussion. So thanks for having my back there, Ben. And Ben and I would like to issue an invitation to everybody watching. If you have an account with X, make sure you're taking advantage of that by following your favorite presenters. You should be following Ben on X at Ben Watson CS, and follow me on X at Cameron May CS. It really is the very best place to connect with us in between these live streams. But let's get right into this discussion. And as we do, of course, we're talking about risks. So let's make sure that we also cover these important disclosures. Bear these in mind. Very important information contained herein. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so with that important stuff covered, let's talk about what we're going to talk about with our 45 minutes together today. We're basically attempting to address an issue that options traders find themselves dealing with, and that is juggling the three variables that can ultimately determine the success or failure of an options portfolio. Price certainly plays a role, but so do time and volatility. So I have an example portfolio of options trades. We're going to go look at that portfolio's exposure to price and time and volatility. We're going to gauge it using the options Greeks. Then we're going to plan a new trade that's intended to be a complement to that portfolio. We're going to be attempting to tailor that portfolio's exposure to some degree to our ongoing expectations for price and time and volatility from the perspective of a hypothetical options portfolio manager. Then we're going to go and place that trade. So that, I think, is going to be a great discussion. Let's go right to the Thinkorswim desktop trading software platform. Now, some of you, I'm aware, we have about 245 people watching the live stream right now. There are going to probably be thousands that watch after the fact. Some of you aren't familiar with this platform that I'm using here. It's called Thinkorswim. It's a trading software platform that can be downloaded from within your Schwab online account. There's no charge to do that. So you just go to your Schwab account. So here I have just a demonstration account. Pop over here to the Trade tab. And in the drop-down menu, look for Thinkorswim Desktop. You could click on that. Just follow the on-screen prompts. There's going to be a big blue button. Can't miss it. As a matter of fact, I'll show it to you. Let's let this load up, and then we'll show it right there. Learn how to enable Thinkorswim. You just click there. Mac, PC, whatever. Okay, So that's going to download Thinkorswim to your computer's desktop. It'll create a little icon on your desktop. It'll put the Thinkorswim in your start menu, and you just launch there. Log in using your typical Schwab credentials, and you're off and running. Okay, so let's go back to Thinkorswim, and let's look at this example set of options trades. Now, if I came over here and click on this little, I don't know, pie slice icon, this is going to reveal all of these different options that we have in place. But, oops, didn't mean to close down everything, but we have a range of options positioned across about 6 different symbols. And these trades, as I mentioned, yes, are going to be influenced by what the stock market does. They're also going to be influenced by the passage of time. They're also going to be influenced by rising and falling levels of volatility. And so to the trader, it might be an important thing to know, well, how much might my portfolio go up or down if, let's say, the S&P rises and falls? How much might my portfolio lose or gain with the passage of a day's worth of time? And how much might my portfolio react to rising and falling levels of volatility on the markets? There's actually some tools here that can help us assess that very quickly on Thinkorswim. So the first thing I'm going to do here is create a few additional columns here on the monitor tab. Now over here to the far right, we have a little gear icon. This is the customize icon. It allows us to customize that set of columns. And I'm going to be adding the 3 Greeks that are attached to those 3 variables. First one is delta. So let's type in delta for available columns. Let's choose that and add that to our list of columns. Then we're going to choose theta. We're going to select that and add that to our list of displayed columns. And then finally, vega. So as I select vega and I add that, delta starts with D, so does dollar. It's a general gauge. It has other functions, but it provides a general gauge of how much an individual option position might rise or fall in value with a $1 change in the underlying security. Theta starts with T, that's the exposure to time. Vega starts with V, that's a gauge of our exposure to volatility. But as I click, actually before I click OK. Oh, John says, can you address the BP effect? Yeah, that's our buying power effect over here, John. That tells us how much basically this is tying up from our available margin borrowing balance. If one is doing that, that's how much that's sort of reduced that available balance, okay? Anyway, but let's actually, before we display these, let's move them up. I want my delta, theta, and vega to be displayed side by side as columns, but how about we put those up here, how about we put them up here by days? So I'm gonna move up delta, let's move up theta, let's move up vega, and click OK. So now let's talk about what these columns are showing us. I already mentioned delta is each position's exposure to rising and falling price levels. Theta is our exposure to time passing. Vega, again, starts with V. That's the impact on volatility changes on an individual position. So as an example, let's just start with theta here. Meet Maya, say this is great. Good. All right, excellent. But let's look at theta for just a moment. And without even knowing what my Apple position is, I can look at my theta and it says 850. That's telling me that if a day goes by and nothing changes, the price of Apple doesn't change, volatility levels don't rise or fall, time just goes by, well, this shows a positive number of 850. That tells us that that position would stand to benefit from the passage of time to the tune of $8.50. All right, and we could just carry that through the rest of the positions, meaning that the next day, over the course of the next 24 hours, if price doesn't move, if volatility levels don't change, and all that happens is a passage of time, which is the one thing that I can predict with a pretty high degree of certainty, this portfolio, as currently constructed, might benefit to the tune of $119 in additional unrealized gains. You can see here are the current unrealized gains, 92.65 on the positions right now. Anyway, so that's theta. Now, vega is our portfolio's exposure to rising and falling levels of volatility. Typically speaking, when volatility rises, options traders can see risk in that, they can see potential in that. Both of those can drive demand for options, which can drive prices of options higher. So typically, if volatility levels rise, a 1% increase in volatility may produce some degree of benefit to options buyers and some degree of negative impact to options sellers. Well, here is that degree for our portfolio across all of our positions. You'll notice it says minus 101. What that is telling us is that if volatility were to rise, the assumption with Vega is always that volatility rises 1%. If we got a 1% increase in volatility, what would that do to our portfolio as a prediction? This is an estimation, tends to be a pretty good one. We don't always get exactly, 119. Actually, theta is pretty good, but yeah, these can vary a little bit. But in any case, yeah, we would stand to lose on a 1% increase in volatility about $101, or at least that would cut into existing profits. If volatility were to drop, well, maybe this portfolio would benefit to the tune of about $101. So these Greeks are starting to tell us the story of our existing portfolio. Hey, we like the passage of time. It's helping. We prefer not to see volatility rise. We prefer to see volatility drop. Interestingly, what has volatility been doing over the last month? It has been not just dropping. Relatively speaking, it has been plummeting. This has really been providing a nice tailwind for this portfolio. Now, finally, we have our delta. Now, delta tells us how much our position might increase in value or decrease in value if the stock price rises or falls. So, for example, if our Apple position were to rise $1, this, as currently constructed, would benefit to the tune of about $73. If Apple were to drop $1, that position would lose about $73. And then we just carry that across the rest of our positions to sort of get an estimate as each of those stocks rise or fall. How much exposure do we have to price changes? Well, what if we aggregate that to a single question? Instead of asking how might this do if Apple goes up and down and Abbott goes up and down and General Electric and IBM, what if we just aggregate and say, well, what might happen to this portfolio if the S&P were to go up and down? How does this portfolio, as currently constructed, typically react to the S&P rising and falling? And that's we're going to use this tool up here. It's called beta weighting. Now go ahead. We have 309 people watching right now. Chat in. Let me know if you've ever used this beta weighting function. Live account, paper money. It's all the same to me. Just have you used it before? All right. But I'm going to click on beta weighting. And what this does, it allows us to use a benchmark to standardize our assumptions about prices. And for our benchmark today, I am going to use the S&P 500. We could type in some other symbol here if we wanted to. For some traders, they might use the NASDAQ 100, or they might use the Russell if they're kind of trading smaller capitalization stocks. Sharon, life in the fast lane, I'd never eat here, say yes. George says never. Tom says no. Sean Cry says no. Dave says no. And Nafiz says nope. Yeah, okay. So I want to go at a pace that everybody can follow, because this thing has kind of an intimidating sounding title. At least that's my opinion. Beta weighting. What does that mean? Well, beta is a measure that some traders will use when they're trying to gauge, when they've asked themselves the question, how does my stock typically do as the S&P goes up and down? Does it typically go up with the S&P? And if it does, how fast does it typically go? If the S&P is going up, does my stock typically fall down? So beta is an examination of the relationship between a stock and the S&P 500. So if our stock typically rises right with the S&P 500, we would say it has kind of a one-to-one relationship, and it would have therefore a beta value of 1. A 1-point move on the S&P, or a 1% move on the S&P 500 would produce an expectation of a 1% move in the same direction with our stock, and so on. So beta can have some uses in that respect. it can standardize expectations about how a whole portfolio might perform as the S&P rises and falls. And so what we're doing here is we're just weighting against, or we're benchmarking against the S&P 500, and notice that our delta numbers have all changed now. Because the assumption of the beta weighting function is that it asks the question, how would, just based on historical performances, how would these positions likely perform in the future if the S&P were to go up not 1%, but 1 point? That's a fraction of a percent. Just a 1 point move on the S&P traditionally on this option trade, which happens to be a covered call, would produce about a $3.35 unrealized gain. If the S&P were to drop a point, we might expect to lose $3.35. And then we can aggregate, we can total those all up, and it can tell us right down here, $14.80, what does that mean? Well, that's telling us, hey, Cameron, the way that this portfolio is currently constructed, based on historical tendencies, if the S&P were to go up 1 tiny little point, because the S&P moving 1 point is hardly anything, that would produce an expected gain of $14.85 total across the whole portfolio. If the S&P were to drop 1 little point, we might lose $14.85. That is a powerful thing to understand, because our trader here now has a very good picture of their exposure to price and time and volatility using these Greeks combined with that beta weighting. JK says, so the delta becomes beta when beta weighting is checked. That's a good way to put it, JK. I think that's great. Yep. It just totals it up as well. So it's weighting it all. The Sarav Kumar asked this question. In general, how many days are used in the beta calculation? Beta actually uses 5 years. Actually, there are several models actually for beta weighting or for beta, but yeah, 5 years is typical. So we look at a 5-year history of the relationship between a stock and its derivatives against the S&P 500, and that might provide the trader some significant insight into how the stock might perform in the future as the S&P moves. Okay, so David says, do you put in the price of the stock in the beta that you're interested in purchasing? So David, no need to do that. We just enter the S&P as our beta weighting, and this just is done automatically. You'll notice all I had to do is check the box, enter my benchmark, and there's my outcome. So let's make some notes here, because how many of you have looked at that and you thought, well, geez, so Cameron, you're telling me if the S&P goes up a point, this portfolio might make 15 bucks. If it goes down a point, we might lose 15 bucks. If you have if a trader has the outlook that the markets are going to be collapsing in the near future, is this the number they want to see in their delta column? Probably not. Maybe they want to reduce that. Now, they could just go clear out all their positions, but let's say they were thinking about adding a new position, but they want to reduce that price exposure. If they think the S&P is about to turn down, what might that do? Well, we need to be able to plan and place an options trade that will reduce that delta for us. It will actually introduce a little bit of bearishness to the portfolio. But we're going to be building and placing a new trade, and we're going to have some objectives for that trade based on what our Greeks are right now. So we have our delta with a current value, we have our theta with a current value, and we have our vega with a current value. So our delta right now is a plus 1481. It's going to change because the values of these positions are fluctuating behind the scenes right now. Let me get my cursor out of the way so you can see that. Our theta exposure right now was 18 and change. It changed literally as I was talking. So let's just go with what it is right now, 1871. And then finally, our vega right now is minus 101.14. So that's how things currently stand. And as a trader is planning a new trade, it could be very important to ask themselves these 3 questions. So pay attention to these 3 questions. Number 1, as we look at that delta, it's positive. That tells me this portfolio is at least to some extent bullish. To give you a little bit more context, this is a $200,000 portfolio. If the S&P goes up a point, this $200,000 portfolio is expected to make about 15 bucks, approximately. Is that a lot? Is that where the trader would like it to be? Would they like it? Would they like this portfolio to be more bullish than that? Or maybe would they like that delta to be lower, be less bullish? That's an important question. Now, we also know that over the next 24 hours, that time is working in the favor of the portfolio, which is great. But there are some sacrifices that are being made to have this positive time decay exposure as well. But the trader might look at that and say, well, do I want my delta to be as bullish as it is? Do I need it to be more bullish or less bullish? Number two is, what do I want to do with that time exposure? Do I want to increase the positive impacts of time? Or do I want to decrease that? I might actually be able to borrow some of that to place a more leveraged trade that might actually chip into that theta exposure. But finally, we have our Vega. Vega is negative right now. This tells us that we have a preference for falling volatility levels, which is exactly what's been happening recently. But do we expect volatility to continue to fall? If it starts to rise, that's going to put a headwind against this portfolio. So there are our three big questions. What do we want to do with this delta with our new trade? What do we want to do with our theta with our new trade? And what do we want to do with our Vega with our new trade? So let's address this one first. Delta. Let me throw this out there for you. Nobody knows the future, but I'm going to give you a quick question, an assignment. The June contracts for options trades expire on the 20th, the traditional third Friday expiration. Where do you think the S&P is likely to be on June 20th? We know what the S&P has been doing recently, but do we expect the S&P to go higher to June 20th or lower to June 20th? That's an important question when we're planning and placing this new trade. So let's go have a look. Here's the S&P. Here's what's been going on over the last 2 months. It's absolutely been rocketing higher. We're up like 23% off of those lows back here. So a huge move in the S&P 500. And as we look out here to June 20th, let's put ourselves in the shoes of a trader who's planning a new option trade for this portfolio. And if the S&P keeps rocketing up, this is great, but maybe we want it to be higher delta, get more of a positive benefit from that price movement. On the other hand, if our trader thinks that we're going to pull back, maybe they want to dial this delta, this price exposure down so they're not as negatively impacted if the S&P decides to pull back through June 20th. So that's the question. So, all right, let's just put ourselves in the mind of our hypothetical trader here. And let's just say they think that prices are likely to rise further from here. Well, in that case, what do they want to do with their delta? They probably want to increase it. Okay. Let's see. Anyway, I was just checking the chats to make sure I wasn't missing anything. JK says, under position statement, my delta column doesn't show how to get it. So JK, earlier I showed how to customize those columns. You can actually go back and review. This brings up an excellent point. You can go watch these webcasts. The vast majority of our webcasts are recorded and then posted to our YouTube channel. So do yourself a favor. Number one, go down and click on the subscribe button. There's one right down the lower right-hand corner of the video stream right now. But subscribe to our YouTube channel. It literally only takes a second, doesn't cost anything. But YouTube is where we house all of the archives for our previous webcasts. A handful don't get archived, but the vast majority do. So then you can just go to our Trader Talks channel on YouTube. Trader Talks Schwab Coaching Webcasts is the channel name. And you can find the playlists for our webcasts right here. You can also join the live streams right here. But as an example, I'm teaching this webcast. It's called Managing an Options Portfolio. If you're relatively new to options, I've actually put together a playlist of videos for the beginning options trader. So I'll go to playlists here, And as I scroll down just a bit, see where it says start here to learn about trading options? You can just click on view full playlist, and there is a series of 10 lessons. I'll just walk you right through. Okay. Earl says is using beta with the S&P 500 preferred versus like an ETF. It depends on trader preference. It's really not going to be a huge difference. But in any case, some traders will prefer to use it like a different index as a benchmark. But yeah, let's say that we want to increase our delta for our new trade. So that's sort of decision number one made. And these are potentially big, important decisions if this new position is going to have exposure to price and time and volatility. What do we want to do with theta? Now, it might seem, oh, well, the passage of time is working in the favor of this portfolio. Don't we always want that? What does it mean? You more veteran options traders, if you see somebody with a portfolio that has a positive theta, what does that tell you right away that they primarily do in that portfolio? Probably tells you immediately, all right, this trader sells a lot of options. Selling options can carry great reward potential, but it also has its own associated risks and potential disadvantages. For example, option sellers have comparatively limited upside when compared to options buyers. Options buyers tend to have that leverage that we've all heard about, but the leverage typically comes at the cost of having negative time decay exposure. So buying and selling, they have pros and they have cons. Right now, we've been primarily sellers of options. So what I might do with that theta, I'm going to buy some options today. I'm actually going to decrease that positive time exposure. I'm going to use some of that, I don't know, currency that we have with time to go out and buy some long options, okay? So we're going to decrease that theta exposure. I'm not saying that's always the right thing or the wrong thing to do. It's just what we're going to do for this example, because then I want to tie it to how do we do that? That's another big question. But finally, our volatility exposure. A 1% increase in volatility could impact our portfolio to the tune of $100. Well, let's go look to see what volatility has been doing. Let's bring up the chart of the VIX. If you're not familiar with the VIX, this is a chart of the expected volatility of the S&P 500. And back in April, in the early weeks of April, when the tariff stuff really started hitting the news, the markets got really volatile. Expectations of market volatility went really high. And you see that spike here on our charts. And that has an impact on options prices. Generally speaking, when volatility spikes like that, the price of options spikes as well because the hedgers are all out there buying hedges. The speculators are all out there buying speculative positions. It can drive up the demand of options and drive those prices up as well. Now, as the volatility drops, those prices can come down, and falling prices can benefit sellers of options. Now, you'll see that expressed here as a negative number. We have a preference for falling volatility levels. With Vega, though, the Greek assumes that volatility rises. And if we rise 1%, if we start to do this, then we start to have a negative impact on our portfolio. I Never Eat Here says hedgers gonna hedge. Yeah, they might see very quiet times as times where they don't really need as many hedges, and there's just not as much demand for options, and the speculators kind of get bored and they don't speculate as much, and so there's not as much demand for options. Options prices kind of settle down. That's just obviously an oversimplification of what's going on, but it paints the right picture, I think. All right, but in any case, where is volatility right now? Well, it has been dropping. That's been helping, but it's maybe it's coming down here to levels where previously it started to rise again. So if it does, that's going to hurt. That's going to sting the existing positions. Maybe we don't want that new position to just throw fuel on the fire here for our volatility exposure. So let's look to decrease this as well. Hold on a second. I have an alarm going off on my phone. That is, hey, there we go. If you want to know what's going on there, it's a reminder to call my mom. Anyway, but our vega, let's look to, I'm sorry, you know what? I'm actually phrasing this incorrectly. I get a little bit ahead of myself. We're going to look to increase it. How do you decrease a negative number? You make it more positive. In other words, we're going to increase that towards zero. Does that make sense? Yeah. You laughing at my reminder? Anyway, yeah, we're going to increase our vega. In other words, make it less negative. So what we've just talked through using our Greeks and our beta weighting is our current exposure to price, time, and volatility, and what we want our new trade to do to that exposure. Well, that's cool. I want a trade that's going to increase my delta, it's going to decrease my theta, it's going to increase my vega. But how do I do that? How do I connect that with a real trade strategy? Well, there are a number of strategies that might accomplish that. So, but I want to write you a little guide for how to tie this to specific strategies. So generally speaking, to increase any Greek, to increase our delta, what would we do? Well, if we're opening a new position, we would open a new bullish position. To increase our theta, when you type and talk at the same time, you don't always get it done correctly. But to increase our theta, if we're opening a new position, we would open a short position, sell something. To increase our vega, we would open a long position. Opening a bullish position increases delta. Opening a short position, selling, creates positive theta. Opening long positions creates positive vega. Buyers typically benefit from rising volatility levels. So this can, now there are going to be a handful of strategies that can fit each of these. I'll show you how to quickly check just to see if your strategy is going to do this. But we just need to do a strategy that's going to meet all these things. So number one, we want our delta increased, open a bullish position. Well, bullish positions, we can buy calls or we can sell puts. Those are the two basic foundations for bullish strategies. But we want to, oh, by the way, we haven't finished our guide here. I got a little bit ahead of myself. We don't want to increase our theta, so we've hit a roadblock here. What do we want to do? We want to decrease that theta. It's saying to open a short position. Well, to open a short position, if we were looking to decrease our theta, to increase our theta, well, to decrease it, we're going to do the opposite. To decrease, let's put a little asterisk here. To decrease any of these Greeks, just do the opposite. That'll round out our little guide. All right? So this says to increase our theta, we'd open a short position. We want to decrease it, so that means that's now a vote to open a long position. Cool. Finally, we wanted to increase our vega, and generally to increase vega, open a long position. So this becomes 2 votes to open something long. What something long? Well, a bullish long something. So what could that be? It could be a long call, could be a long call vertical. There are other things that we could do. But yeah, we're going to be doing a long call vertical spread today. So let's do that. And the stock that we're going to do that trade on is PM. Philip Morris. Why did I choose PM? There are a number of reasons why traders might choose to trade what they're trading. But one of the considerations when trading options for lots of traders out there is liquidity. Illiquid stocks tend to have illiquid options. That can lead to pricing issues, very wide spreads between the bid prices and the ask prices. So Philip Morris is one of the biggest companies in the world. Number 2 can be price per share. very high-priced stocks can have high-priced options, and they can also carry very large risks and obligations. Obviously didn't close off my... All right, there we go. Somehow snoozed that. Let's throw the phone across the room. There we go. Anyway, where the heck were we? We were... Can't be that. I don't think I've ever lost my train of thought ever in a presentation. Anyway, oh yeah, so liquidity, price per share, can carry big obligations. Yes, it can give us big rights, but they can be expensive rights. Now, a final consideration is what is the chart of the stock doing for it? And it's not the final consideration. It's the final one that I'm going to discuss today. Other traders can have other motivations. But some traders will look at a chart and they'll say, well, if I'm about to place a bullish trade, does this thing even look bullish? Well, with Philip Morris, it hasn't been for the last week. It's actually been pulling back, but maybe for some, they might see it as being interesting that that's pulled us back down to a trend line, a rising trend line. It's also a previous price ceiling that may act as a new price floor. Might even see some interesting things happening with the candles. If one studies candles, right now I can see something looking like what we call an inverted hammer, which is a bullish candle. But in any case, let's just say that our trader has the conviction that, hey, this looks kind of bullish. Maybe we're about to bounce off this level and start to rise. So this could fit the role of a bullish trade candidate. So let's go build a bullish trade that's going to fit all the pieces of what we want this to do for our portfolio. So I'm going to go to our trade tab and we're going to construct a bull call spread for the 20th of June. That's just the third Friday expiration for June. Why did I pick that? Well, the traditional monthly expirations, the third Friday expirations, tend to be the most liquid options. Doesn't mean there's anything inherently wrong with the weeklies. They just tend to be a little less liquid. So I'm going to go for the third Friday in this case. And let's go for, let's say, the 165, 170 call spread. So if our trader thinks our stock is about to take off and run here, let's say they think it's going to pop up here, maybe it's likely to go up above, at least in their view. Mathematically, it may not be. But let's just say they think that the stock is likely to pop up here and go up above 170 before the 20th of June, and they want to attempt to leverage that. So for this example trade, we're going to buy the 165 call, which is going to give us the right to buy shares for 165. We're going to sell the 170 call, which gives us an obligation to maybe have to sell those shares for 170. And if both of those contracts are ultimately exercised and assigned, we buy the stock at 165, we sell the stock for 170. It's a $5 profit potential if this were a free trade to set it up. It's not a free trade. It's going to cost us some money. Nafis says, aren't illiquid options better because you can get a deal? Nope. No. You might think, oh, there's low demand here. I'm going to provide the demand and maybe they're willing to come to the negotiation table. It doesn't work that way in options trading. No, I get your line of logic there. It just doesn't play out in real life. Okay. But let's see how much this trade is actually going to cost us. And there's a function here on Thinkorswim that can show us that, but it can also show us how this option is going to impact our portfolio as far as our price, time, and volatility exposure is concerned. And that's right up here. Do you see where it says spread single? That's showing us all the individual strikes, all the single strikes. I'm going to change that to vertical. And it pairs up those strikes one with the next. So I can look at that 165, 170 vertical spread combination we were thinking of trading. And then I can look over here, the bid and the ask price. Looks like it's going to cost us about $2. So it's going to cost us $2 to set up a trade where we might make that turn into as much as $5. If we can turn $2 into $5, that's a $3 return. That's 150% potential return. There's some leverage there. But what impact is this going to have on our Greeks? Well, we can look at our delta and theta and vega columns here. Now, if you're not seeing these, we can select those right up here. So like let's say your columns are showing last price and net change. We just come up here change those to our Greeks. This one will have an extra Greek in there. That's okay. Gamma, not going to worry about this for this discussion. But here, let's see. Let's go to our 165, 170. What is our delta between the call that we're buying and the call that we're selling? That's creating a positive delta. Didn't we want to increase our delta? Yep, we sure did. Between buying the 165 and selling the 170, that's creating a negative theta. It's going to decrease our theta exposure. Isn't that what we wanted to do? It sure is. Finally, our vega is positive. Didn't we want to increase our vega? Yep, that's exactly what we wanted to do. So just looking at these columns on Thinkorswim can give us insight into how much this trade might cost us and its impact on our portfolio, on our exposure to price and time and volatility. And it can help us to tailor our exposure to where we think price, where we think time, and where we think volatility are headed. So to place that trade, we just click on the ask price. That creates a buy order right down here. So I'm pretty much done with what we've been discussing over here. Let's hide that. And by default, for my setup, it's for one contract. And for now, we're just going to leave it at that. Just doing one contract. Buy the 165 call, sell the 170 call. Maybe you want to spend up to, let's say, $2 as our example here. Let's set that as our limit. But I'm just going to go ahead and click confirm and send. And this is in order to buy our one vertical, the 165, 170 call spread for $2. That gives us a maximum profit of $300, a maximum loss of $200. There is a commission to be paid that can chip into that, can add to the cost a little bit, chip into the reward potential a little bit. And that would be it. Send this order off. I'm not going to do that. I'm just filling in here. I wouldn't be around to talk about exiting this trade in the future. But we have accomplished what I set out to do today. Now, let me ask the question. I think we've covered a lot of ground. Do you feel like you know everything about options trading? Probably not. There's a lot more to be learned. So make sure that you continue to watch our videos. Make sure that you have subscribed to our channel. It doesn't cost anything. You just go down and click on the subscribe button. But our channel is where we house our webcast series, the archives for those. Again, you can find those. Let me just delete this trade. I don't need to submit that. But you can find our channel on YouTube. It's called Trader Talks Schwab Coaching Webcasts on YouTube. Just find it. Go to the playlist right here. You can join the live streams right there. I have another suggestion for you. Also one that doesn't cost anything. If you have an account with X, you should be following your favorite presenters there on X. You can follow me on X at Cameron May CS. Let me show you that. Actually, let me just promote Ben for a minute. You can follow Ben Watson at Ben Watson CS on X. Ben's fabulous in everything he does. Full endorsement, ringing endorsement from me. But the best place to connect with your favorite presenters is on X, in between these live streams. You can find me there now at Cameron May CS. But with both of those, you want to make sure that you are, pardon me, precise with your typing. At Cameron May CS, there are lots of similar names out there that aren't exactly the same. You just want to make sure you're following the right guy. Sorry, the voice is starting to give up. Anyway, but for example, you can see things on X. You can connect with your favorite presenters. You can also get more current information when we don't have the luxury of turning on the camera and talking to you directly. For example, I gave a quick 2-minute demonstration of a tool that can only be found on Thinkorswim called the Market Forecast tool. So you may want to check that out. I just posted that maybe half an hour before this webcast started. All right. But everybody, thanks for giving me your time today. Thanks for, I think I had, 315, 20, 30 people watching live. Looks like 60 people have already clicked the thumbs up. That's always appreciated. If you watch one of our webcasts and you enjoyed it, make sure you click the like button. That's a pat on the back to your presenter. It also gives, my webcasts a boost in the YouTube algorithm, helps more people find these discussions like managing an options portfolio, and they can learn these techniques and these tools. So it only takes a second, doesn't cost anything, and it helps. So it's always appreciated. Everybody, thanks for giving me your time today. Yeah, Nafis says, don't forget to call your mom. Yep, I agree with that. So I won't forget. I've been reminded twice. Anyway, I'll look for you in a future webcast. As a matter of fact, I have one coming up in another hour. So we're going to be talking about getting started with Thinkorswim. I'll see you then. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.